Hey traders, Raghi here. Let's get a quick audio and video check in. Should be good to go. All right. Welcome to our 5 steps to managing risk conversation. This is a conversation that was happening in my office a few years back. And one of the things that is really a big point for really the foundation for my trading and consequently teaching and mentoring is I want traders to know that, the foundation of all of this is built on something one of my mentors taught me, which is blowing up an account is not a rite of passage for traders. And frankly, if you've done it, it's really not your fault. No one taught you that that's not okay. It's always been dismissed as, oh, well, that's tuition for trading and things of that nature. And I really find that to be untrue. And it's a really painful thing that a lot of traders have had to needlessly go through. So what I'm hoping is this conversation begins at least a process of maybe some learning and maybe some unlearning. And I'll give you some strategies and some tactics to be able to get on that path of understanding that our job as traders is first and foremost risk management. I know it's not sexy, right? It's so much more fun to talk about a new strategy or a new secret squiggle. And all those are great, right? I love talking about an indicator that I might have, just created and I want to share with the world and clearly the strategy around it. But I do know the one thing that keeps traders able to come back and hopefully make a living in the market is in risk management. So with that being said, let's dive into this. I believe if you go into the Room Drive, which is, I know some of you may not be familiar with the Room Drive. And if you're not, I think I have an image. All right, here we go. Whatever room you're in, that half open looking folder is the Room Drive. If you open that up, there is, I believe there will be, a doc called, 5 Steps to Managing Risk. And if it's not there now, it will be shortly. 5 Steps to Managing Risk. Okay. Pretty simple stuff. I don't want to, deliver a bunch of sort of the kind of advice you'd get when you crack open a fortune cookie, right? So we're going to dive into a little bit of detail on this. And we're going to just go ahead and start off with number 1. And again, important conversation, one that a lot of traders overlook, but it's the one that is going to allow you to manage hugely volatile days, frankly, like we had yesterday. If you take a look at what we were dealing with on the Jackson Hole, right here, that Jackson Hole sell-off, right? If you were looking at even yesterday's sell-off, this is what's going to help you, not destroy your account. And we'll talk about that. All right, so starting off with number 1. And by the way, I'm going to go ahead. So I like to take notes while I talk. If for no other reason, it keeps me on track. And it allows everyone else to, not have to write notes yourselves, although I encourage everyone to do that. But I'll keep notes and I will send these out to you all right now. And this way, hopefully, you can take away a lot more from this conversation. The link that I'm sending you does not require a username or password or anything like that. Just click on the link, and as I update it, it too will update. Now, if you've been in any sessions with me, you know that as we're live trading, I put my notes in this software called Workflowy. It's just a website, kind of like Evernote, just a little bit different. So just click on that link, and you'll be all set. All right, let's get to it. 5 steps to managing risk. And if you have any questions, I'll leave some time for questions, gang. So really simple. Step number 1 is know how much you can afford to risk per trade. And some of these are going to sound a little bit, well, no duh, Raghi. But I'm going to talk about how I do it just a little bit here. So first of all, this has to be before you trade, right? Before you enter a trade, what is the budget? Now, I know some of this terminology may not be normal to trading, but this is very normal in the way that I process risk. And by the way, I probably should have kicked it off with this. Everything that I'm sharing with you all, gang, is not theory. It's practical. And it just starts with, I have never blown up an account. I mean, so please know this is coming from that perspective. And this is what's kept me from that. Again, if you have, not your fault. Unless someone sat down and explained this to you, how would you know, right? I realized I was very fortunate to have a mentor walk me through it. And again, I hope to impart that to you all. All right, so back to know how much you can afford per trade. Before you trade, what is the budget for the trade? Now, gang, everything I'm going to share with you is my experience, what I've applied to the market. I am never going to insinuate it's the only way. It's my way. It's my opinion, right? And therefore, take what works for you and discard what doesn't. That's what's so great, right? So before you trade, what is the budget for the trade? Your budget, by the way, has to be, well, if you think about it, it's got to be calculated based on your account size, which goes to the fact that no one else can tell you how many shares or contracts you should be trading. I only know how many I can trade, and there should be a formula, right? There should be a formula. My basic formula, without the ability to get into a lot of detail in our 30 minutes together, I want to make sure I at least give you all some thresholds so that blowing up an account is a distant memory if you've ever done it. And if you never have, my hope is you never will. Your budget has to be calculated based on your account value, right? How many dollars do you have in your account? My recommendation has always been, do not risk more than, now this is a maximum, this is not what you have to risk every time, but do not risk more than 5% of your account on any one trade. And then I'm going to add to that, right? Do not have more than 9 trades open in that account at one time, right? That have not at least hit the first target. This is a really important point, gang. I've taught this in the past in classes, so this is stuff that some of this stuff, right, is things that I know are going to move the needle if you want to try it, right? So do not have more than 9 trades open in that account, in your account, that have not hit the first target. Okay? So that's one of the first steps. How much you can risk and how many positions you can have open. And that's going to become a whole lot more clear when we get to step 5, which is avoid risk of ruin, which is never, hopefully, I can't promise anything, right? But, how do we not blow up an account, right? That's what that really should be in step number 5. So step number 1, know how much you can risk per trade, all right? And those are 2 really, hopefully, helpful steps that get you started. Those are some of the initial steps to get you started. All right, next is trade probabilities, all right? Trade probabilities. Gang, they call it fishing and not catching, right? We call this trading and not winning. There's a reason. On any trade, you could lose. So trade probabilities means, for me, I am always asking a simple question. How much could I lose on this trade? Now, how much could I win? I know the winning side, gang, is so much more fun to talk about. That's enticing. Controlling down. Look, I don't jump out of bed in the morning, usually around 4 in the morning. I call it cat o'clock. Some of you have cats, know exactly what I'm talking about. I don't jump out of bed in the morning and say to myself, yay, I get to control risk today. I get up and I want to trade and make money. But I know the path to a career. Mine's now over 32 years. I know the path to a long career, especially one where I'm not tearing my hair out, is one where I've focused on controlling risk first. All right. How much can I lose in this trade? So see rule number one. I won't even call it rule number one. See step number one. Okay. See step number one. How much could I lose on this trade? And this brings up another word that isn't often used in trading, and that is the trade affordable? There are trades that are picture perfect on the chart. All our secret squiggles are firing off in the way that we want them to, and yet we go on over to the option chain, or we take a look at the initial margin for that futures contract, or we look at the price per share and say, whoa, that is not in the budget. That is not something that I can afford. Gang, if you and I went to the gym, okay, my old trainer, his favorite thing to do was if, the gym we were at, sometimes the younger men would be at the squat rack, loading up the plates and doing curls, right? Bicep curls on the squat rack, right? They would use up the squat rack for that. So my trainer would take us over there, put 225 in the bar and have me squat, right? Just to kind of, to be a little smart aleck, right? But if I started there, he would have killed me. I would have folded in half and been in the hospital. I didn't start there, right? I didn't, that's not where I began. And if we go to the gym and pick up the heaviest dumbbell we can find and decide we want to overhead press it, we're going to hurt ourselves. Where we are now, whether in the gym or in our trading, is not where we're going to be. So remember that. If you're trading small now, learn the good habits now, because those are going to scale. Whatever mistakes, whatever errors in your trading you're making now, whether that be position sizing or stop loss, those too are going to scale. So why not, as a small or new trader, start off with a scalable approach? And that goes to asking a really simple question, which is this affordable? There'll be a time where you can trade anything. But right now, if you're honest with yourself, maybe there's a couple positions that are pushing your risk parameter because the setup looks so good and it's so volatile and, oh, this one's definitely going to double my account, right? We start to take outsized risk. And by the way, it's an interesting phenomena for traders who have smaller accounts. Traders who have smaller accounts tend to want to take far larger risk than traders who have larger accounts. When I talk to traders with, say, 5-figure accounts and even big 4-figure accounts, right? Versus traders who have 6- and 7-figure accounts, they risk less. Because the hope is with a small account, we can double it really quick and start trading larger. I hope that makes sense. I'm telling you these things because these are all mistakes we make, including myself. Believe me, most people are smart because they've made a mistake and learned from it, I hope. Some people are wise. They learn from other people's mistakes. I'm not wise, right? Someone had to tell me, don't touch the stove, it's hot. I had to touch it, right? Most of us are going to learn that way. All right, so if we think about affordability, remember where you are now is not where you're going to be. If the trade presents more than that 5% risk, don't take it, right? And be very prudent about using credit spreads as a way to make things affordable. A really dangerous thing that a lot of traders do is they figure, well, if I can't afford the debit, let me flip the trade around to a credit because that makes it affordable. Be careful, gang, because the volatility is still there. So just something to keep in mind. All right, the next thing is something that used to be very common amongst traders, and it seems to be very uncommon now, which is scale into your trades and also scale out of your trades. Now, I remember back in the late 80s, early 90s, even early 2000s, this was very common. Somewhere along the line, traders have sort of turned into point A to point B. as a general rule. I'm sure there's still plenty of traders who scale in and scale out, but it seems to be an old school thing that I wish would come back. So hopefully now scaling in and scaling out is going to make a comeback. And what that means is there's no one magical price that is the level that from there the market's going to go in your favor. Not usually. It happens every now and then, but the truth of the matter is, and you've probably observed this, trades tend to happen in zones. There's a zone of support. There might be a zone of resistance. Things don't turn on a dime. I wish they would, but they just don't. So by scaling in, I'm able to divvy up my trades into what I call an aggressive, moderate, and conservative level. Each one has its own risk and cost associated with it. And so what we know with aggro, moderate, and conservative is we're consciously acknowledging the risk from the entry to the stop loss. Because risk, by the way, think of it this way. Risk is the chasm from, so risk is the distance, right? From entry to stop multiplied by the number of contracts or shares you have, right? That's risk. So if I can consciously think about from an aggressive level, trading less of my budget from that aggro, maybe a little bit more at the moderate, and the most at the conservative, what I've done is the level that has the furthest distance, which is the aggro to the stop loss, is a smaller position. Moderate could be the same or a little bit more. And conservative, the entry that has the least amount of distance from the entry to the stop, is the largest. Now, what's small and medium and large to you? Again, this is where you crunch the numbers and do the math. But once you understand what your budget is, you can start to split it. It could be an even split. That's fine. But we should never build top-heavy trades. We should not have more size at the aggro and less size at the conservative. We don't want to build an upside-down pyramid when we're scaling in. We want to build it triangular, right? We don't want to have more risk at the aggro and less at conservative. It should be the other way around. So that's why we scale in and scale out. That brings us to number 4, our stop loss. Okay, I'm going to talk about 2 kinds of stop losses. For me, there is, and these are just Roggeisms. These are things that I've just made up because it just visually or from a meaning standpoint makes more sense, and therefore I'm more likely to follow them. All right. So we all have a stop loss. We're all told to trade with a stop, which is true. By the way, would it surprise you to know there's actually no such thing as a stop loss order? It could be phrased that way, but it's just a stop order. It's a market order with a price trigger. We happen to be using it to exit a position that's moving against us, but at the end of the day, there's only 3 ways to get into a market. They can be combined in different ways with conditional orders, but you can either market order in and out, stop order in or out, or limit order in or out, right? So a stop order or stop loss order is just the point at which we say, that's it. That's what was that, uncle? No more. If you're my jiu-jitsu fans out there like myself, you're tapping out. That's okay. There's 2 types of stops, right? There is an interesting phenomena of negotiating your stop. Because if someone says, well, I have a $100 stop, why not 110? Why not 150? Why not 200? So it's too negotiable. I found for me, I ignored them because they weren't based on anything other than either some arbitrary level that I'd read or attended a seminar or read a book, or one that I just imposed on myself. It was just too arbitrary. Now, there is value in a number based on your account. That's what we talked about earlier. But a $100 stop, if not rooted in cost per trade or your account size, is arbitrary. And your brain knows this. You know it. That's why it's so easy to negotiate a different number, right? Marketers know this. Why is it that the increment between small medium, and large is always designed to make us buy the large. There was an interesting study, interesting offer from the Financial Times not too long ago. They offered the digital, I think it was Financial Times. They offered the digital for, I don't know, $30 a month or whatever it was. I can't remember the numbers. And they offered the physical and the digital for, I think, $30 a month. And they realized that people would look at that physical and digital for $30. And even if they weren't thinking about buying the Financial Times, they bought it because it looked like such a good deal. We are all going to be susceptible to that sort of numbers malleability. We're always going to say, well, what's another $10? And all of a sudden, you're way past your initial number. All right. Okay. That's a big lead up, right? For stop losses, I have two kinds. This is what means something to me. Two kinds. One is the more numbers oriented, that budget, that affordability oriented paper cut. So a paper cut is a paper cut stop loss is a percentage based stop. Okay. The percentage is less important than you're acknowledging how much of your account you're risking. So this goes right back to please don't risk habitually more than 5% of your account. It could be far less, just max out at 3, no more than 9 positions. So it's a percentage-based stop. The other is the main stop that I sort of derive for myself. It's not that it's any different to stop loss. I just call it something else. It's a point of validity stop loss. Now, why did I start calling it this? I think I started calling it a point of validity in my first or second book. So we're talking early 2000s. And a point of validity stop, as the name suggests, is where is the trade no longer valid? That's a very different question than what most traders ask, which is if I still have time on the option and it hasn't gone to zero, there's a chance, right? That's why max debit is so popular. There's never, again, only my opinion, there is never a reason, if we're long a call or long a put, to risk max debit. It's just the hope that if it hasn't expired and there's a little bit of time left, it could always come back, right? Hopes and wishes are for birthday cakes. They're not for the market, right? So there's a point on the chart or a point within the value of the option. It could be because of time decay. Could be because of a reversal in the trend. Some reason where this trade is simply no longer valid. And that is the point of validity stop loss. So when I would fight my POV, my point of validity stop loss, my brain is saying, Rog, it's past validity. If you want to do the dumb thing, go for it. I'm reading a book right now called The Road Less Stupid. And it reminds you of something Charlie Munger talks about, which is, he doesn't try to be brilliant. He just tries not to do anything dumb. I'm paraphrasing, of course. He said it much cooler than I did. But in my mind, trading is a lot the same way. I'm not trying to put on the trade of the century where Michael Lewis is going to write a book about me and, here comes the movie. A lot of traders think that way. They want the big short trade. Good luck with that. People forget oftentimes that, Michael Burry was down some, 20 some odd percent in the account before it came back. Or I forgot what the drawdown was, but it was beefy. The truth of the matter is most of our trading is going to be much more mundane and no one's ever going to write a book about us. And that's okay. That's okay. But we have to remember that our job is to not blow up. And that extends down to individual positions. Right? So where is the trade no longer valid is what keeps us in business. And if we don't know that level, then we're left to zero, which really should not be, for me, anything. I don't teach that, right? I don't teach that. You'll find, and go back and study, don't take anything I'm telling you, at face value. Question it, use it, right? The idea that once you've lost 50%, 50 is usually a threshold that I have found very common. Once you've lost about half the value of the option, again, these are debits I'm talking about. These are long calls, long puts, right? When you've lost about 50%, how often does it come back? And if you're honest with yourself, you'll say, yeah, Rog, not very often. Because the risk of ruin, oftentimes for both an account and an option position is about 50%. Theta decay, momentum, trends, they've eroded the value of the option. So why give it all the way to zero? I have even found that it can be less than 50%, but 50 is a great place to think about how often does it come back. The problem is the bias that we develop when that down 50% option comes back. And even though it's probably the lower the probability outcome, boy, is it memorable, right? It's super memorable and therefore becomes disproportionately our reality. When the reality is it doesn't happen that often at all. So keep in mind where the validity of the stop is. And I personally, right, I never risk what they call max debit, right? In other words, all of what I paid on an option. Every trade has a point of validity and zero is not it. All right, that brings us to avoiding risk of ruin. So what is risk of ruin? What is a blown up account really? It's not zero like the option conversation. It's a drawdown. It's a loss of half the account. At 25% drawdown, now 25%, 25%, gang, that's going to be something you'll probably experience pretty commonly in your account. Drawdowns happen, right? Drawdowns happen. You will have a string of 3, 4, 5 losers sometimes, right? Like on days like yesterday, it could happen all at once. But as long as you haven't lost half your account, there's a better chance of coming back. You still have capital. And where there's capital, there's some confidence. When you lose 25% of your account, tap the brakes. The 25% level of account loss is like those bumps in the side of the highway to sort of remind you that you're wandering out of the main road. It's just a reminder to, straighten up. Take stock of what's going on around you and straighten up. 25%. 50%, you're definitely heading towards the ditch. Just what happens when, what happens if you're heading towards the ditch? You hit the brakes hard. You stop. You don't hit the gas. You don't try to maneuver out of it. You just stop as best you can. That's the way I look at it in terms of losing 25%, tap the brakes, figure out what's going wrong. And at 50%, really 45 to 50, just stop, because whatever's happening is either an immense amount of volatility in the market, or we're on the wrong side of the trend, or something. We need to know what that is. The only way we're going to be able to do that is by stopping and getting flat. Because the only way to regain perspective is to be flat. Fresh eyes, an open mind, very difficult to have with a bunch of open positions, much easier to have with closed positions, even if that means you've lost 35, 40% of your account. Because the alternative is beelining to zero and a blown up account. And again, if we say halfway is where we've quote unquote blown up, remember to come back from just halfway down, 40, 50%, you've got to trade pretty much perfection to get back to even. Think about the way in which you gain back what you've made. And if you've lost 50%, traders usually do two things. They start increasing their bet size. Right? So now they're doubling up, hoping they're going to make it all back, and they trade even more. And then they wonder why now the account's 10%. All right? So I'm explaining some of the pitfalls too. Hey, guilty as charged. That's why I know what it looks and feels like. Been there, done that, right? So that's what risk of ruin is, okay? One other thing, a little bonus here. A little bonus as we wrap up our session. Fixed bets. I don't say bets to somehow insinuate we gamble. In fact, when I was first trading, and this would have been in my late teens, early 20s, my mom used to say, well, isn't that kind of like gambling? And I used to get so upset. Whenever my mom would say, you're kind of gambling, aren't you? You're not going to law school and you're back in your bedroom gambling. She wasn't that harsh, but that was what I heard, right? Well, kind of, yeah. But I thought that was a put down. And later on, I got to teach a gentleman how to trade. who was an honest-to-goodness professional gambler. He was written up in Forbes. He thought it was going to be in Rolling Stones. Rolling Stone magazine. He was so upset, ended up in Forbes. But he was written up in Forbes. He was just he's an honest-to-goodness professional gambler. He lives in Toronto. So I flew up there, got to take my mom to the Niagara Falls. She was so happy. And I sat and taught him how to day trade for 3 days. And with him, I realized it's okay. He said, "You're not gambling." I said, "I'm not?" My mom says I am. He goes, "No, you're professional gambling." And he was right. When he would go gamble, because then I went and gambled with him. He played craps, amongst many others, but he took me playing craps. He had a stop loss. He had a lot of strategies that if you replaced dice with Apple, was pretty darn similar. And what I learned from him was the value of a fixed bet size, because I don't know the outcome. Right? And this is what I teach and this is what I do. Okay? I don't know the outcome. There's this idea that somehow we know, well, this is going to be the big winner, but this one I'm not so sure about. Why would I take the trade I'm not so sure about? Fixed bet size assumes that we don't know the outcome. Fixed bet size assumes that our winning trade could be one that we really kind of overlooked. And fixed bet size is how I can put 9 positions on and have a pretty darn good idea, barring gaps, where if the you-know-what hits the fan, where my account will be. All right, so I use fixed bet size. What that means is every trade is using the same amount of dollars. And I still do that to this day. It didn't matter if it's a $10,000 account, a $250,000 account, or a 7-figure account. I've been at all 3. I still use fixed bet size. The only difference between Raggi at $25,000 and Raggi at $2.5 million was the number of contracts that I traded. And back to the affordability, what symbols were affordable. So more of the market is accessible with a larger account. But I was still using the same indicators you see me use today. So those are the 5 steps of how Raggi manages risk. They aren't the only way to do it. They're simply my way to do it, gang. And I hope that that gets you on a path to never blowing up an account. This is what put me on a path to never blowing up an account, because I crunched the numbers and I knew the math, and I didn't go to the gym on the first day and think I was going to squat 2 1/4 for reps, right? I got there. Eventually I was able to do 315, but I thought it was going to kill me. We go to the gym, we build the muscle. Risk is like a muscle. Okay, gang? I'm happy to answer a few questions. I hope that was helpful. You have the Doc in the Room Drive. So this is a sort of really foundational look at my overall risk approach. And then on top of this, obviously there's a lot more detail. We get into that in when I'm in the rooms with you all setting up trades. A lot of you know, okay, this is how we divvy up our budget and so forth. But this is really a great foundation from which to build hopefully your trading plan. All right, any questions on risk management? And again, I really want to remind everyone, if you've blown up an account, don't be hard on yourself. If no one taught you that that's not okay, or worse, said it was okay, it's not your fault. But now, as of today, gang, with what you know from here on out, you can say, okay, I get maybe how that happened, and I understand how I can avoid that happening again. And that's really what I hope you take from our 33-minute discussion here. All right, I'm going to go to 34 because that's a Fibonacci number. So any questions? All right. Okay, cool. Good stuff. Good stuff. All right, thank you, gang. No, good. I hope that was helpful. I hope that was helpful, and I'll see you next time.